Well, the highlight for last year was really the sale of CH8 in Warsaw. That was the largest directly held asset that First Property Group had. And we made a profit of about £1.5 million on the sale of that property, but that wasn't really the crucial aspect of that sale. The crucial aspect was that it released £17 million of cash into our balance sheet. And that puts us in a fantastic position to navigate the pandemic and the ensuing economic problems that the United Kingdom, I think in particular, is going to face, though Poland, of course, won't be entirely immune. That cash gives us enormous buying power, and we would expect to emerge from this crisis actually stronger than we went into it, having been able to, I suspect, pick up some good property investments en route. And we've maintained our final dividend, which actually means that for the full year, shareholders have had a slight increase in dividend compared to the prior year, 1.67 pence per share versus 1.66 pence per share. And I am very proud of that. We held our dividend throughout the credit crunch years, and we are doing it again during this pandemic-induced crisis. In terms of pre-tax profits reducing from 7.25 million to 5.5 million was really a result of two things. The first was that we had some one-off profits which didn't repeat, and the second is that Fprop Opportunities PLC had a markdown in the value of its two shopping centres just after the pandemic kicked off, and that caused us to have a write-down in profits of about £600,000. So it was the absence of one-off profits together with a slight markdown in the value of our properties. Though I expect the value of those properties to bounce back once. It is worth mentioning Poland specifically, which went into this pandemic with a strong national balance sheet. Government debt as a proportion of GDP was around 49%. And they've been able, therefore, to stimulate their economy without being overburdened by debt. They were quick to lock down, they were quick to open up. They opened their economy back up on the 4th of May. And most economic commentators are forecasting that Poland will be one of the best performing economies in Europe. And of course, the bulk of the group's profits come from investments in Poland. The group owns a large proportion of offices, and they won't be as badly hit as the retail sector will. Our retail assets will come under some pressure, but I would hope that once the government stimulus feeds in, even if rents settle at a lower level because of adverse economic conditions, actually asset values will hold up well because of all the QE and low interest rates. That's what we saw in 2008 after that credit crunch, and I suspect we'll see a similar pattern this time round.